up moves. Aman Chowhan is with us, fund manager at Abakkus Asset Management. Aman, good to have you with us here. Thank you very much for your time. Just your views, Aman, with this correction that we have on our hands. And, the fact is that it's banking which is contributing to the bulk of the sell-off today.
Sure. So I think just a one-day move, nothing much to read on it, except that the markets were overbought. We had a very strong performance over the last few weeks, and the market just wanted a reason to book profits, and it came via the HDFC Bank results. So nothing much to read into it. Nothing much has changed, except that one result was not in line, and it was an overbought market. So we can't be rallying all the day non-stop. So that's just one of those days when the market is correcting and booking profits. That's what we are reading out of.
Aman, what about the fall on HDFC Bank itself? Is it appearing a bit excessive? We already had the provisional numbers. We knew the kind of deposit mobilization the bank has done. But today you're staring at an 8-9% fall. So is the fall a bit overdone, according to you, on HDFC Bank?
Looks like the numbers are not as bad as to warrant a 8 to 9% move, that too in a single day. And not much materially has changed, except that the outlook on the margins is now slightly lower than what it was prior to the results. So definitely it looks on the excessive side.
Right. Hi, Aman. Good afternoon. Nigel on this side. Aman, out of the portfolio that you're managing, how much of the money is towards banks? The reason I ask this is because, yes, HDFC Bank, it appears a bit of a disappointment for the street. The problem is the read-through is still deposit mobilization seems to be a problem, which could keep the NIM suppressed for a longer duration. And if that happens, then some of this valuation argument could get pushed back. What's your view? What's the current exposure and how would you approach the banking space?
So we will be roughly around 25 to 30% exposure into financials, but that includes everything, NBFCs, banks, private as well as PSU banks, and some non-fund based financials also. And that's what broadly what the exposure is. For us, we continue to like the private banking space and the stronger NBFCs, and that stand doesn't change.
Okay, Aman, got that. So you're not in the camp, obviously, that's getting a bit concerned seeing this as more than a one-quarter issue, because to sort of press Nigel's point further, I guess what a lot of analysts today are talking about is just, how will they mobilize these deposits and whether this is going to be an issue that will take a little longer to fix.
So ultimately, it's simple that they have to garner deposits, and that will happen through some hit on the margin. So they have to maybe give a better rate to garner more deposits, and that will have a near-term impact on the margin. So ultimately, that is what is going to be. That's what I said. Ahead of the results to post-results, the main thing which has changed is that now we are heading towards a slightly lower margin assumption for HDFC Bank than what it was before the results. And I think in a quarter or two, the street will, as well as the valuations, will adjust towards that, and post that, it should be back to normal.
So got that point. That's a view on banks and financials. Let's talk about the other major pillar of the market. Now, we had those 2 solid days, right, after the TCS Infosys numbers, 2 back-to-back days of intense buying on IT. The question is whether that was the celebratory sort of 2-3 day pop, and now we're back to looking at, questioning the more sustainable growth rates, or do you think IT can really provide a meaningful, leg up from here? And in your portfolios, what's your positioning right now on the services technology?
So you can say we are neutral on IT. We would have high single-digit exposure on IT, and that has always been the case of the last 2-3 years where our IT exposure has been. Even now, we would have a neutral stance. It's still 1-2 quarters away before the growth rates materially start to look up. Even this quarter, numbers were not great. They were in line with expectations. Expectations were low, and the company happened to deliver or marginally improve on those expectations. It was more of a meeting expectations rather than giving an absolute growth or giving an absolute reason to rejoice. Having said that, there are other technical factors also. IT had not performed, the whole market and moved out. There was some valuation re-rating pending. If Infosys is trading around 20 P multiple, 20-22 multiple, that's relatively much better than buying a 30-40 P stock, right? So there are many other factors which come into play besides just quarterly numbers or besides just earning. And I think that has played out in IT. So it was a relative underperformer. There was a catch-up rally which was pending, which happened. And I think another at least 2 quarters before we start to see the numbers coming in. So the first movers in IT who don't want to wait for another 1 or 2 quarters and are pretty confident that is going to happen, that there's going to be a recovery and there are going to be rate cuts, which ultimately will feed into the IT spending, have started buying IT. The relative underperformer chasers also started buying IT. People like us who already have an exposure would prefer to be very selective. So we would have added a new IT name, a small exposure in the last month or so, but we will continue to be selective. Wherever we see growth picking up, wherever we see a good earnings visibility in IT, that is the stock we would bank on rather than just looking at relative underperformance or outperformance.
And how much is it of the portfolio, you said? You're neutral, that's the stance. And how much does it weigh in the portfolio right now?
It will be high single digits in most of the portfolios.
High single digits. Okay, got it.
Aman, I know timing the market is impossible, but we are in a kind of market where markets are at all-time highs. The question is what to buy. Markets fall a little bit. The question is what to buy. So my question is, should one be prepared for a bit of a sort of cooling off, sideways kind of market? Do you get that sense? You've seen markets for a long time. What's the view at Abakkus? What are the discussions like? Yeah.
So we have very strong few months, especially since April. It's almost been market on a roll. So a few months of flat performance shouldn't be a surprise. That can happen. There can be definitely a time correction that we feel. We are not unduly pessimistic or worried that we can see a sharp fall in the market. We don't see any reason for that to happen. At the same time, the forthcoming general elections are also known. It's not going to be a surprise if the ruling party comes back, right? So markets will run up ahead of that. They are not going to wait till the elections. Some of that move has already happened. A bit of news, I think, pending, which can happen, but not necessarily in this month. It can happen in February, March also. So that's broadly what the market setup is. And hence, as you said, can't time the market. So just focus on stocks, focus where we see things improving and invest into them. So that's the stance which has always been and I think continues for even now.
You've been bullish on the entire engineering space. Is that correct, Aman?
We are, but valuations are north of 40p, so we don't have much of exposure into the portfolio. But as a view, yes, definitely we are positive.
So, did you bring down your exposure to any of these engineering, companies because of the run-up that we've seen and higher valuations?
Not much. So the companies that we own in this space, overall, we would say a high single-digit to mid-teens kind of exposure into capital goods or engineering stocks in our portfolio, and we are maintaining that weight. So the stocks that we have are relatively much better valued versus what the leaders in the stack would be, and hence we are continuing to own them. I don't think there's not much of new stock that we have added in this sector. Okay,
got that. Any other broad sectoral theme? Pharma, for example, came back into the mix recently. Anything where you're reasonably more optimistic for return generation?
Pharma definitely looks positive. We also have a positive since last at least 3-4 months now and continue to stay positive on pharma. EPC companies are looking good. Infra plays are looking good. Financials is anyway everybody's favorite, so we are also in the same camp. That segment is also where the risk reward equation seems to be favorable. So these are the sectors that we are looking at. Cement, it's a wait and watch. We feel cement can give a positive surprise. So that's something that we are positively looking forward to.
All right, Aman, we'll leave it there. Thank you very much for joining us. Great speaking with you here on CNBC-TV18. It's always a pleasure. It's a bit of a down day today.
For more news and updates, all you need to do is follow CNBC-TV18 on all of our digital platforms.